Let's talk about getting a deal. All right, folks? Let's talk turkey. You found it, the one. Perfect kitchen for your questionable cooking experiments. Backyard big enough for that inflatable T-Rex. It's beautiful. It's perfect. But the price tag? Woo! It's a little high. Now your real estate agent, Showcase Showdown Champion Energy, starts throwing around terms like seller credits, price reduction. You nod along, trying to look smart, but inside, the losing horn plays. Don't you worry, we're going to break it down so you can feel like a winner. Real estate offers can feel like guessing the price of a fancy European sports car. Do you go high? Do you go low? What if you overbid and look like a fool? It's enough to keep you in your tiny apartment, debating extra guacamole. But getting a deal isn't about luck, it's about strategy. Asking for a price drop versus asking for seller credits. It's a game changer. Let's start with seller credits, the shiny prize behind door number one. What in the world are they? Think of them as a cash bonus the seller gives you at closing. It's not like they hand you a briefcase full of money. That would be a different kind of show entirely. Instead, the seller agrees to pay for a portion of your closing costs directly from their proceeds of the sale. These are all those pesky fees that pop up at the end of the home buying journey. Loan origination fees, appraisal fees, title insurance, and other things that sound incredibly boring but cost a lot of money. Seller credits are the seller's way of saying, hey, let me help you with that. Let's put this into a real-life example. Suppose you want to buy a fabulous house listed for $400,000. You love it, but you're a little short on cash after saving up for the down payment. Your closing costs are estimated to be about $10,000. Yikes! So you make an offer for the full $400,000, but you ask the seller for a $10,000 credit. If they agree, you still get a loan for $400,000, but the seller uses $10,000 of their profit to cover your closing costs. This means you only need to bring your down payment to the closing table, not the extra 10 grand. It's like winning the punch-a-bunch game and hitting the big money slot every time. The beauty of seller credits is that they solve a very immediate problem, the giant pile of cash you need on closing day. Now let's spin that big wheel and land on the price reduction. This one is much more straightforward. There's no fancy footwork, no credits, no cash changing hands at closing to cover fees. The number on the sales contract is simply less than what the seller was originally asking. It's like when the announcer says the retail price is $5,000. You correctly bid $4,500. You just saved yourself $500. Example, our $400,000 dream house. Instead of credits, you offer $390,000. If they accept, congratulations. You're under contract for $10,000 less. Your loan amount will be based on this new lower price. This is the big kahuna of long-term savings. Lower loan principal, less interest over 30 years. It might not feel huge on day one, but savings add up over time. Biggest advantage, lower monthly housing payment. Borrow less from the bank. Monthly mortgage is lower. $10,000 reduction. About $50 to $60 saved per month. That's over $600 a year. Over 30 years, tens of thousands saved in interest. It's the gift that keeps on giving, like a lifetime supply of rice. But here's the catch. Price drops don't help with closing costs. So you have two great options. One saves you cash now. The other saves you cash over time. How do you decide which path to take? It's time to play a little game of financial plinko. Let's watch where the chips fall. Your decision should be based entirely on your personal financial situation. Are you scraping together every last penny for your down payment? Or are you sitting on a comfortable pile of cash? The answer will guide you to the right choice. Be honest with yourself. Don't pretend you're a high roller. Let's drop the first chip for a buyer who is cash poor. They saved for a down payment but have little left over. For them, seller credits are a godsend. A $10,000 seller credit means they don't drain their emergency fund or sell prized collectibles to close. Their monthly payment may be higher, but they can move in without being completely broke. That breathing room buys peace of mind when unexpected costs pop up. Now drop a chip for a buyer who is cash rich. They have a solid down payment, healthy savings, and aren't worried about closing costs. For them, a price reduction makes more sense. You understand the difference, you know your financial situation, and now you're ready to make an offer. It's time to step up to the podium and make your bid. How do you frame your offer to the seller to maximize your chances of success? Remember, a seller's goal is to get the most money in their pocket at the end of the day. This is called their net. Whether you ask for a price drop or a credit, a savvy buyer frames their offer in a way that appeals to the seller's net while also achieving their own goals. If you need seller credits, one popular strategy is to offer the full list price or even slightly above it while asking for the credits you need. For example, on that $400,000 house, you might offer $405,000 but ask for $10,000 in credits. The seller still nets $395,000, which might be more than if you had just offered $390,000 outright. This can be a win-win. The seller feels good about the sales price and you get the cash you need for closing. It's a bit of psychological jujitsu, but it often works beautifully, especially if the house appraises for the higher value. On the other hand, if you're aiming for a price reduction, a clean, simple offer is often best. The price is right when it works for both you and the seller. Good luck, and may all your bids be winners.